Welcome to Phillip Futures Weekly Market Watch. I'm Lynette Tan, investment analyst from the Phillip Futures investment team. Spot gold has recently been trading in a tight band, ranging between 1,610 to 1,680 since the start of April. The reason for the range-bound trading is due to the mixed bag of data coming from major economies such as Europe and US. This week, we saw gold hitting a two-week high on Tuesday as upbeat US manufacturing data soothed worries about the economy and dampened hopes of further monetary easing. After a recent run of weak data, the Institute for Supply Management said that US manufacturing grew in April at the fastest pace in 10 months. Stronger economic growth will decrease the need for the US Federal Reserve to further ease monetary policy. This will also dent investor appetite in gold, which benefits from low interest rates. Moving forward, we expect investors to shift their focus to the US non-farm payrolls data due later today. If the non-farm payrolls turn out better than expected tonight, we can foresee more downside to gold prices, and the US dollar is likely to strengthen. Investors could also be paying attention to the weekend elections in France and Greece taking place on Sunday, 6th of May. The upcoming elections are increasing uncertainty in the markets. In France, a likely socialist François Hollande victory could cause market jitters given his rhetoric about the world of finance. Hollande escalated criticism of Europe's debt crisis response this week, pushing back against Merkel's focus on deficit reduction. If he wins, we can expect some conflicts between his push for social spending against German Chancellor Angela Merkel's support for austerity measures. In Greece, the last polls before a two-week ban on voter sentiment readings showed no party has a mandate to enforce the austerity policies that the nation needs to stay in the Eurozone. It therefore seems that the elections will be a test of the European nations' resolve to deal with their issues. We maintain our short-term forecast that gold is likely to range trade as the upside potential is capped by a more optimistic outlook on the US economy. In addition, the Eurozone risk could also lead to more demand for the US dollar. The increasing divergence between the economic outlook for the two major economies is likely to work together to keep gold prices pressured at the moment. Our long-term outlook on the prices of precious metals remains favorable. Firstly, there is uncertainty of any improvement in the Eurozone economic climate. Secondly, we expect that an accommodative policy from the Federal Reserve is required to maintain a sustainable US growth in a key election year, which is likely to happen after Q2 this year. This will devalue the US dollar and in turn provide support to gold prices and demands for preservation of wealth. Another reason for longer-term support for gold prices is the continuing trend for central banks around the world to trade in their paper money to buy gold. The IMF reported that during the month of March, emerging market central banks purchased a whopping 58 tons of gold bullion, and this does not include what is widely believed to be large-scale buying by the Chinese. Mexico, Russia, and Turkey were the three largest buyers, and gold purchases are expected to continue throughout the year as Western central banks continue their easy money policies. After being net sellers of gold to the tune of 400 to 500 tons per year in the years leading up to the financial crisis in 2008, central banks became net buyers in 2009 and purchased 440 tons of gold last year, the biggest increase since the 1960s. This has been another major reason why gold prices have been rising in recent years. We expect gold to continue its 12th year of rally in 2012, with prices likely to test the resistance of 1,800 before breaking beyond the high of 1920 that was hit last year. That's all I have for this week. Thank you for watching.